Welcome, and we're pleased you could join us today for a look back at the past 12 months and how Australian Ethical has navigated COVID and managed to outperform many of our peers and mainstream managers. I'm Leah Willis, Head of Client Relationships at Australian Ethical, and welcome you and appreciate the number of people that have joined our webinar today. In terms of housekeeping, please note that we've changed the order of the speakers today. However, we will still be online for just the hour, and I would encourage you to ask questions in the toolbar at the bottom of your screen. We'll be monitoring these throughout, however, we will leave formal Q&A to the end of the webinar. Before I kick off, please note the disclaimer. This information is general information only and doesn't take into consideration your personal circumstances. Please refer to the PDS or obtain financial advice. It's very easy sitting here post-COVID to it's very easy in the current environment to forget about the devastation of the bushfires that swept through Australia earlier this year. As a result, climate change concerns peaked and investors flooded into investment solutions to address the issue. This was quickly followed by the challenges of COVID that are now driving demand to approach things differently and build back better. Media headlines, consumer groups, and even corporates are all pushing for a green recovery to benefit the economy and the future of our planet. And that makes ethical investing more important than ever. But why is it important to you as financial planners? We know now that responsible investing stands at almost $1 in $2 of all professionally managed assets in Australia. More than 2 in 3 Australians don't want their money to cause harm, and 9 in 10 Australians believe it's important for you as financial planners to provide responsible and ethical options. And post-COVID, we have well and truly dispelled the myth that our clients don't have to compromise to invest ethically. Our My Super Balanced option was ranked number 2 to 30 June in the 1-year Chant West survey. Now more than ever, your clients will be wondering what their investments are funding, and we know they'll be looking to you for help. For those of you who are joining us for the first time today, Australian Ethical has been passionate about investing responsibly and helping people to align their investments with their values for over 30 years. Today, we're an ASX 300 listed company managing over $4 billion on behalf of our super members, managed fund investors, advisors and institutions. We differ from most mainstream managers though, in that we believe we can balance profit and purpose. By investing ethically, we have proven we can provide competitive returns to our investors and positive outcomes for society and the planet. We have a positive impact through our portfolios, the way we advocate on critical issues, and by supporting not-for-profit and social enterprise initiatives through our foundation. To provide some context to today's session, I'd like to spend a moment on our very unique ethical investment process. We know from the Investment Trend Survey that many of you planners are already using ESG funds and may feel that you're already ticking the responsible investing box. While more managers and super funds are excluding tobacco and weapons, we would argue that this is expected by consumers. The RIA surveys tell us that consumers want managers to go deeper and consider issues such as fossil fuels, human rights, and animal welfare. We see responsible investing as a spectrum from light to dark green, with ESG being the lightest and ethical being the deepest approach, given the breadth of issues we consider on behalf of clients. Our ethical charter has been guiding our investment decisions for over 30 years, and considers positive outcomes first, and then looks to avoid unnecessary harm from what a company produces or how they run their business. This provides us with what we call our ethical universe of stocks. Once we have our investable universe, our investment professionals apply a very traditional bottom-up stock picking approach to construct portfolios to deliver competitive investment returns. So with that, I would like to hand over to our speakers for today. First, Dr. Stuart Palmer, our Head of Ethics, who will share insights on how we've implemented our charter and some of the key ethical considerations he and his team have debated over the past 12 months. He will in turn hand over to our CIO, David Macri, who will lead you through how our unique ethical investing process shapes our portfolios and how and why they have outperformed during COVID.
So I might just get going with the ethics update. So the ethical charter has been unchanged over the whole life of the company, so for well over 30 years now. It's a series of principles which guide our investments. Basically, we're looking for companies which are producing positive impact in their products, services and the way they operate, and which are avoiding unnecessary harm. And we're thinking here about the interests of current but also future people, animals and the environment. As I mentioned, it's a set of principles which you can have a quick look there. It's on our website. It's in all our product documentation, in all our fund constitutions. But you'll see it doesn't actually specifically rule in or out specific sectors or specific types of companies. So I want to just run you through the process that we follow to actually implement that ethical charter. When we look at a company, the starting point is what's the core product and service which the company's delivering? Do we think it's part of a better future for people, animals and the environment? The second part of the process is looking at whether the company is operating in a sustainable way. So it might be a renewable energy company producing lots of good clean electricity, but if it's disregarding the rights of its employees, of communities who are affected by its development of hydro or wind farms, then we're going to have a concern and may potentially screen it out on those grounds. We have a ethics research team, in-house team of 3 people, but we're leveraging, and that's really important because our process, the breadth of issues that we look at is, and the way in which we look at the ethics independently of the financial analysis means that we need strong in-house capacity around that ethical screening. But we do rely and leverage the growing amount of ESG research and analysis which is out there. So that's the traditional providers like the MSCIs, Sustainalytics, ISS, but also the body of research which is coming out of scientific institutions, academic institutions, and also from NGOs who are often on the ground looking at the way companies are operating in specific markets, how they're managing their supply chain and so on. The way we think about companies in individual industry sectors is governed by sector frameworks. So whilst I've explained that the ethical charter itself, those principles haven't changed, what sits under them does develop over time. So we have an energy framework, a retailing framework, a property framework, and these sector-specific frameworks govern how we're going to think about companies which are operating in those sectors and whether we're going to assess them as being aligned with our ethical charter and therefore coming into the universe, or whether we're going to rule them out. And they're the sorts of things that do change over time. We spend a lot of time internally researching on them, working when they need to be updated. The energy framework, for example, has developed significantly over time. The challenge of climate change has always been on the radar and very significant in our screening. We've never invested in coal or oil, but it was about 5 years ago that we finally excluded all our remaining exposures to gas. And that was basically looking at the growing need for more urgent action on climate change and also the advances in renewable energy technologies and storage technologies. So to give you an idea, just a quick example of some of the sorts of frameworks that we have, climate change, there's actually not a specific climate change framework. What we refer to there is the way a number of different frameworks take into account the challenge of climate change. So I've mentioned the energy framework. Renewables is where our investment focus is. We believe we need to support the transition to 100% clean energy electricity system. The banking sector obviously funds businesses across the economy. So from a climate point of view, when we're looking at large institutional banks, we're looking to see whether they're aligning their lending decisions with the Paris Agreement transition and objectives, which is to limit warming to 2 degrees and then to 1.5 degrees. Human rights framework, there's pleasing really to see a lot of increasing focus in business and in the investment community on management of human rights impacts across companies' direct operations, but also across their supply chains. The catalyst for that has been the Australian modern slavery legislation. So as a consequence of that, we've updated our human rights framework and the way we are screening companies against their management of human rights impacts. And yeah, we're as in a number of other areas, yeah, the bar on these sorts of things does raise as expectations and practices around company management of these issues thankfully improves. The food framework I might refer to in a second when we talk about a specific example, investment example. I want to move on though to talk a little bit about the companies we rule out and exclude to give you a flavour for what doesn't go into the universe. So it can be a specific sector. So the fossil fuel sector, we don't invest in that sector at all. In other sectors where we do invest, we invest selectively. So the financial services sector is a very important sector for the efficient allocation of capital, allowing people to borrow, businesses and consumers to borrow to fund the things that are important to them. At the same time, we're all very acutely aware of the shortcomings of that sector revealed, for example, in the Royal Commission and various other regulatory action that has followed and preceded that. So an example of a company that we've excluded under our financial services approach is Prosper, so small business lender, which we assessed as being not investable because of the way it was representing its funding costs to its clients. So the Charter specifically asks us to look at the way that goods and services are marketed. In the financial services context, we think transparency around the costs, the interest rates applicable to borrowing, are absolutely fundamental to allowing consumers to make an informed choice. And so in that case, Prosper was excluded. Now, pleasingly, they have changed some of the ways that they're disclosing their interest rates, and that means that company may be eligible in the future for investment by us. The example I've got on the screen there is a bit of a quick case study. Marsh & McLennan is a global insurance brokerage company, also has brands and businesses like Mercer in the investment space. They were providing services to Adani to help Adani obtain insurance for the Adani Carmichael coal mine, a project which is fundamentally not aligned with achieving the goals of the Paris Agreement and limiting warming to 2 degrees. So that caused us deep concern. We were already invested in Marsh. So our first step in that sort of situation is to engage with the company and to see whether we can change things. In this case, what we were asking the company to do was to introduce clear guidelines and commitments, which would give us comfort that they wouldn't provide services to support a project like this again in the future. We made some progress in our engagement with them, and they did ultimately produce a statement which indicated circumstances in which they might refuse to do work for an Adani Carmichael type project in the future. But it was very general. It basically wasn't good enough in the climate situation that we're in. We expect much clearer commitments from companies, large financial institutions, about how they're going to allocate their expertise and their capital to support and not support new infrastructure, particularly in the energy sector, particularly in high emissions sectors. On the positive side, an example, Sundrop Farms. Any of you are familiar with this greenhouse tomato farm in a very arid region of South Australia down at Port Augusta, is actually pulling seawater out of the ocean using solar energy to desalinate that water to grow greenhouse tomatoes, producing over 15% of Australia's tomato supply. So an amazing story really in terms of an agricultural story, a healthy food, which is minimising its impact on the environment in the way it operates. But great product, great service, still not a perfect company. We don't find perfect companies to invest in. So there were some areas that we engaged with the business about, was how are they treating the workers in their agricultural activities. It's been a bit of a focus for us and others in the last few years because of concerns about mistreatment temporary 457 visa workers. But anyway, we were satisfied about that and proceeded through the Morrison Infrastructure Fund to invest in that project. So I'm going to wrap things up soon. I guess wanted to step back and just make it clear that there's a number of different ways that as an ethical investor we seek to have a positive impact with our clients' money. Firstly, by applying the ethical charter, we're aiming to allocate capital to businesses which are part of a better future for people, animals and the environment, and to keep that capital away from businesses which we think are threatening that future. So that's the power of the capital allocation decisions that we make on a day-to-day basis. Secondly is the advocacy lever that we have. So as an allocator of capital, we have a platform to exercise, we think, strong influence with the companies we invest in or the companies we may not be investing in to encourage them to operate more sustainably, to better manage their environmental impacts, their social impacts. So we do that in a range of ways. We do that directly with companies through private meetings. We do that collaboratively with other investors and other businesses. We also do it publicly. So we believe it's really important that where private engagement is not producing the outcomes that we're looking for, that we're upfront and open about that, and we see what sort of public pressure we can bring to bear. And an important tool that we have as a shareholder is that we can get shareholder resolutions on the annual general meeting of companies, which can provide us with a very public opportunity to ask questions of a company and to influence them to take what we see as better action to promote the interests of people, animals and the environment. So an example earlier this year with one of the NGOs that work in this area, Market Forces, we co-filed a shareholder resolution calling on QBE to be clearer about how it was going to align its investment and its insurance activities with the Paris Climate Agreement and those objectives to limit warming to 2 and 1.5 degrees. And the third lever I mentioned here, which is a little bit out of the investment process, but worth mentioning, examples of that range from support for large NGOs like the Wilderness Society, TWS, Human Rights Watch, down to funding smaller grants to grassroots community organisations who are doing great work, supporting animals, supporting vulnerable communities. So an important part, complement to the investment process, we strongly believe in the power of private capital and markets to achieve positive change. At the same time, we see a strong role for a vibrant civil society and NGOs to address needs that currently aren't being met by either government or private markets. I guess I'm going to close with that. I've just left on your screen there, I guess, some examples of the sorts of organisations that we're part of, we work with, and which part of the growing responsible investment community. Really important for responsible investment to have a united voice as long-term investors. We also, our products and funds are certified by the Responsible Investment Association. We're a certified B Corp, Google B Corps if you're interested in that. Basically, purpose-driven companies which recognise that alongside profit for shareholders, pursuing important environmental and social goals is core to being a responsible business. Anyway, I'm going to hand it over now to David, our Chief Investment Officer.
Hello, everyone. Thank you for joining us. So, investment update. I'm very, very happy to provide this update. It has been a good year in terms of our investment performance. So, just to give an overview of the team and the process, just remind everyone that we do have a team and an equities capability that is recommended by Lonsec and highly awarded not only as a leader in ethical, but a high performer against all comers, including other mainstream competitors. Our Australian Shares Fund has been around for more than 20 years, and the lead portfolio manager, Andy Gracie, has been leading this fund for over 10 years. He has a strong team of very high quality and experienced analysts, and I'm very, very privileged to be leading that team. The fund has applied a consistent investment approach and style that has provided strong, consistent outperformance in most market conditions. And today I will spend some time talking you through how the fund has performed in a period which includes unprecedented levels of volatility brought about by the COVID-19 pandemic. But before that, I wanted to quickly touch on the fact that we have a small cap and an SMA portfolio that leverages the work done by our equities team, and which are both rated as recommended by Lonsec in their own right. The SMA is available on Premium and Hub24 and will soon be on other platforms. Now, let's take a quick look at the Australian Shares Fund and its portfolio positioning. The fund's strategy is to invest in a diversified portfolio of companies listed on the ASX and the New Zealand Stock Exchange, which meet both our ethical criteria and that have investment appeal. To give you a feel for the extent of our ethical screening, we exclude around 60% of the ASX 200. And while the fund has a substantial exposure to large cap stocks, it's around about 30 to 40%, it is heavily weighted towards small caps. And that's where we have historically added significant alpha. It is in that small cap market segment. And relative to large caps, we think small caps are under-researched and where much of the upside resides on the ASX. The resultant portfolio is effectively an all-cap strategy with a skew to growth factors over time, and the fund is completely benchmark unaware and utilises an active stock picking management style. And once a stock enters the investable universe, it enters the portfolio on the basis of relative value, where we deem the risks are being adequately priced. So you can see there, we do have some exposure to New Zealand, and a lot of the New Zealand exposure is within the utilities sector, where a lot of the power generation is generated by renewable energy. So what we end up with is a very different portfolio to the market indexes and market indices and other managers. And this chart shows the sector allocations. And as you can see, we have little to no exposure to energy or materials and significant overweights to healthcare, IT, and utilities. This is a well-diversified portfolio that avoids the concentration risks and inherent biases of the Australian market, which has a high concentration to the banking sector and to the mining sector. So there is a perception out there that when managers screen the universe, the resultant portfolio will be a higher risk, but we have clearly demonstrated that this portfolio has generated lower standard deviation and higher return than our peers and all mainstream ASX indices. This is probably due to multiple reasons, such as the fact that all managers screen the universe, they just do it differently. For example, most managers would screen by market cap, not for any fundamental reason, but because they're simply managing too much money. And another reason is that the index itself is inherently risky. So why construct portfolios based on a risky index? There's no real fundamental reason except that it reduces their business risk of underperforming. In this chart, there is a risk return scatter plot. Our Aussie Shares Fund is the blue dot. You can see it has outperformed with lower risk compared with the index, which is the yellow dot, and the median manager, which is represented by the lines there. So it's that top left quadrant where you really want to be. So this chart goes to demonstrate our carbon emissions exposure of the portfolio. The International Energy Agency has warned that the world, and I quote, has no room to build anything that emits CO2 emissions if we are to meet the upper limit of the Paris Climate Accord. It is likely too that existing fossil fuel infrastructure will have to be shut down. So for us, this is not a new consideration. We have been committed to climate change and reviewing the impacts of climate change for decades, and we have a very clear approach that shapes and guides our portfolio. As an example, we won't invest in coal, oil, or gas companies. Stuart touched on, that we have never invested in coal or oil, and 5 years ago or so, we made the decision to divest from all gas infrastructure as well. We do go further. We don't invest in big polluters and high carbon emission industries such as air travel, car manufacturing, or land-based animal agriculture. And we take a positive approach and invest in renewable energy and battery storage to support the transition to clean energy. This approach means we have nil investment in fossil fuel companies, produce a portfolio that has 75% less carbon emissions than the index, and has 6 times more investment in renewable power generation than the market. We believe by refusing to invest in companies that are causing climate change, we are denying them a social license to operate, and we believe consumers more than ever are looking for this leadership from business on critical issues. So coming down to how the fund has performed, and it's obviously very pleasing to see that the fund continues to outperform in challenging investment markets. As we all know, it's been a tough start to 2020, but we have continued to significantly outperform the market. And as you can see on the right-hand side of the chart, our fund was able to deliver a positive 3% return over 12 months ending 30 June 2020, compared to the broader market index return as measured by the ASX 200 index of negative 7.7%. Over the COVID-19 periods, the crisis when the markets really tanked by around 20%, we have participated over that period in over 25 capital raisings, deploying over $60 million in capital, with half of that going to support the healthcare and IT sectors. What did we do? What did we do well during the crisis? I think we stuck to our investment process, and I continually asked the team to look through the pending earnings gap and focus sharply on sustainable earnings. It is this that should have driven, it is this that drives valuations. It's the sustainable earnings. It's not looking at the next 12 months earnings. And clearly nobody has conviction around near-term earnings. Nobody knows how long the recovery will take, but what we do know is that investing is a long-term game. So some of the drivers of the 12 months performance, you can see from this table, the stocks highlighted in red are excluded from our investment universe due to the ethical screening. So some of the drivers were, the portfolio is underweight the oil and gas sector, also the banking sector. Those were 2 of the worst performing sectors over the 12 months to June, with the banking sector down 28%. So clearly this contributed to relative performance, and as did our overweight positions to the 2 best performing sectors being IT and healthcare. The fund's largest individual contributor was Macquarie Telecom, which was up over 120% over the 12 months, driven by the surge in demand for data center capacity. Fisher & Paykel Healthcare was another strong contributor. It was also up 120%. And this chart just goes to show our holding in Fisher & Paykel Healthcare. It has been a long-term holding for our funds and has a proven track record of innovation. It is a key supplier of equipment and consumables to hospitals, but also competes effectively against ResMed and Philips with its CPAP masks. And more recently, it has innovated new technology known as nasal high-flow oxygen therapy, which has been growing strongly, but accelerated even further as it is being used to treat COVID-19 patients who don't require intubation. And as a result, the Fisher & Paykel Healthcare share price has risen materially, and actually since then we have widened our position, but we still remain invested. Max7 is an interesting company, and it sits across both the IT and the healthcare sector. It's a small weighting in the Aussie Shares Fund, but is currently one of the biggest positions in the Emerging Companies Fund. It's an enterprise software company which provides software for archiving medical images. It has been winning new clients against larger incumbent players, given the low footprint and versatile nature of its solutions. It recently became cash flow positive and acquired a complementary image viewing company, which has greatly expanded the addressable market. We expect this acquisition will lead to even further market share gains. The share price has performed well, but we continue to like it as it has a healthy tender pipeline, which suggests strong growth into the medium term. This is I guess a summary of the performance of the Aussie Shares Fund, and you can see just the consistent relative performance, the consistent alpha generated by this fund over not just the near term, short term, medium term, but also over the long term and the very long term. This fund's been around for over 20 years, and you can see that the since inception number of positive 13% relative to its benchmark of 9%. We're also very proud of the performance of the Emerging Companies Fund. This fund has a mandate to invest only in ASX 100 stocks, and it does have a 5-year track record. And within those 5 years, it has performed excellently. And the since inception number, you can see its relative performance and the benchmark versus its benchmark, which is the ASX Small Industrials. It has outperformed that index by almost 8% per annum. Just wanted to touch on our balanced fund. We do have a diversified multi-assets solution for clients and for advisors, for your clients. The balanced fund has also performed very well. The philosophy around how we manage that fund, we do believe that strategic asset allocation is the main driver of long-term performance and volatility of that performance. We don't believe superior risk-adjusted investment performance can be sustainably achieved by attempting to time the markets. And as such, we do not engage in dynamic or tactical asset allocation. We aim to construct well-diversified portfolios, not only across the balanced fund, but within each asset class, obviously within the context of our ethical charter. And we do leverage our internal sector funds, as you'd expect, the listed asset classes, but we do seek to invest with specialist managers for the illiquid asset classes, which includes property, infrastructure, private equity, and venture capital. So very proud of the balanced fund performance. We've maintained our resilience and delivered a positive return even through the COVID-19 pandemic crisis. And pleasingly, it's outperformed 9 out of 10 competitors, compared with a decline of more than 4% for competitors. This is according to Bloomberg, and their data also showed that we've topped 95% of similar funds over the past 5 years. So again, we performed well over the recent period, but the long-term performance shows how we've just been managing to do that consistently. So with that, I think we're very happy to take questions.
Thanks, David. Just in respect to the balance fund, I was just wondering if you could go into just a little bit more detail about the property and alternatives managers within the balance fund.
Sure. So so we do outsource those asset classes, and there's a lot of work that we do in doing the due diligence and also researching which funds are appropriate for our fund to invest in. Obviously, it has to meet our ethical criteria, but the current funds that we invest in within the property sector is the Investor Commercial Property Fund, which is a big institutional fund. I think it's a 5 billion fund now, and that invests in commercial, A-grade commercial assets. And that has actually been the best performing property fund over the last 3 years, and I think also 5 years, which is exactly the time we invested in it. So that's been a great investment for us. Another investment in the property sector is the Wholesale Healthcare Property Fund managed by Dexus. Obviously, Dexus is a big name in the property funds management space, but this fund is dedicated to finding assets within the healthcare sector. And I guess when going into this fund, we really tried to look out, over the long term, And we came to a view that healthcare could, and we think it will, be another significant institutional sector for the property fund, for the property asset class from institutional investors. At the moment, you have commercial, you have retail, you have industrial. We think healthcare is going to add another pillar to that asset class. Dexus are very committed to not only the sustainability of those assets that will be in the fund, but a real commitment to growing the fund and making it the premier fund in the healthcare space. Within alternatives, we really tried to anchor the alternatives allocation with an infrastructure investment and really trying to diversify that exposure and not just invest in single assets or even within a solar farm in North Queensland, may well be a great asset, but what we're looking to do is really diversify that exposure. We found a great fund managed by HRL Morrison & Co, and it's a more of a core growth strategy. And the fund has the capability to invest globally, but it will be majority Australian, New Zealand investments. Great investments in the sense that it's, yes, it invests in renewable infrastructure. It invests in renewable infrastructure in Europe and Australia, potentially the US, and it also invests in other assets as well, such as social housing, data centres, and obviously the Sundrop tomato farm, which Stuart spoke to before. We also have some investments in venture capital, primarily focused on technology, the IT space, and also in the clean tech space, and looking at making some PE investments, which would have a global focus but high impact strategy.
Thanks, David. Just a quick question and quick response, because I know it's going to be pretty straightforward. Do these external managers all fit within our ethical charter?
Yeah, so we look at not only how the manager invests themselves, so investor has a very deep commitment to sustainability in their commercial assets, but we look at the underlying assets in the fund as well. And with commercial property, it does meet our ethical charter when we look at the property framework. Technology usually ticks the boxes as well because of its driving efficiency, but we do have visibility in the underlying investment, and if we deem it not to meet our ethical charter, we can avoid exposure to that asset.
Perfect. David, there's a couple of questions around the team and the resourcing. Would you maybe be able to just quickly expand? Andy Bracey's been our lead PM for over 10 years on the Aussie Equities Fund and Emerging Companies Fund now, but we have a depth of resources in terms of senior analysts. So could you just quickly talk to the team and the resourcing? Yeah,
sure. So our team, very, very experienced team, very senior analysts, all of them in their own right. Ray Jin, who is an equities analyst covering the financials and also a portfolio manager for the Diversified Shares Fund and the International Shares Fund. He has over 30 years experience. He's previously worked at ING Investment Management, covering the banks there, and also a long time on the sell side with Deutsche. Mike Murray, who is a senior analyst, was a founding analyst at the AMP Sustainable Share Fund, or Sustainable Strategy that AMP used around 20 years ago. He also was the portfolio manager for the values-based portfolios during his time at Integrity Investment Management. He's responsible for healthcare and biotech, and is the backup portfolio manager to Andy Gracie for the Australian Shares Fund and the Emerging Companies Fund. Deanna Mitchell joined us a couple of years ago from Macquarie. She was a leading small cap analyst, but prior to that, she was looking after the ESG research for Macquarie. And Mark Williams, who covers a lot of the utilities and the telco companies for us. He had a long career at Morgan Research, and was one of the highest rated analysts there. So yeah, very deep, a lot of deep experience, and well over a 20 years average experience for the team.
And just quickly again, any intention to add to that team in the near term?
Yeah, look, we're constantly looking at how we can better resource the team and what new skills and new perspectives we can bring. So yeah, we are.
Now, one particular question before we might move on to Stuart from an ethics perspective was, can you please share a little bit about the sell side? And I'm assuming the question refers to what are your considerations? What's the rigor around, how long are you going to hold onto a stock based on maybe valuations, etc.?
Yeah, sure. Great question. So, within our investable universe, it does tend to have growth factors over time, but the way we manage the portfolio in the active portfolios anyway, in the fundamental bottom-up research, we are very disciplined around valuation. There's a lot of work that goes into formulating a fair value, and I'm sure everyone's aware that there's a lot of work done in earnings forecasts and how resilient those earnings are, but also then on the valuation, how do you actually value those earnings and what time horizon you look at. So a fair value for a stock isn't going to be an exact number. So it's always a range that we're comfortable with, but definitely if a stock gets too overvalued relative to our fair valuation, we would sell it. And Andy has a great sell discipline, and I'm always on top of the team, questioning and scrutinising the investment thesis for everything we hold.
Perfect. I think at that stage, we're out of investment questions, so we might actually move on and grab Stuart again in front of the camera. There's quite a few questions, as we always get, that have come through. I'm going to pose this first. It is a common question we always get, and it has come up on today's webinar chat. Westpac and NAB, why do we continue to hold them? And it seems incongruent to the charter. Maybe just quickly, because there's a lot of other questions we can move on to.
Okay, so yeah, start with the sector, the finance sector. We think it's positive. I think I've already covered on sort of some of the high spots, but more generally, it facilitates the efficient allocation of capital, and if done in an effective way, which takes account of environmental and social considerations, absolutely critical to growing a better future for people. Within the sector, obviously, we Australians, with very good reason, love to hate banks, and big banks in particular. Lots of missteps over many years. So it is probably the most challenging part of my job, working out, well, which banks would we invest in and which ones won't we? I guess one point to make is that, there's a reaction, which is, why wouldn't you just invest in the small banks? Surely they're better. I mean, that's not our experience. That's not the output of our research. When we look at customer complaint levels, when we look at their lending practices, we think some of the Australian big banks are leaders in this area, and it's a view shared by some of those global ESG research companies in terms of looking at climate policies, climate action plans of banks. Westpac, ranks at the top or near the top on many of those international league tables. So yeah, I don't want to defend the banks in the sense that obviously there's been lots of missteps that we continue to scrutinise and engage with them on, but we do think they're an important part of the economy and building a more sustainable future.
Thanks, Stuart. One that's received a couple of questions on the chat today is Afterpay, and I think it came up on the slide where we had the stocks up, and we obviously don't hold that currently. Someone has mentioned, is that because they promote and encourage debt or irresponsible spending? Can you maybe talk to that? Yeah,
so that's a concern with the financial services sector generally, and something we look at carefully. And I mentioned the concerns about Prosper, a concern about potential misleading about the cost of credit there. So we invest in the sector. So we're already running that risk with some of our investments. We invest in companies with credit card businesses. So the specific concern about Afterpay, there are a range of concerns, but how it was being used. So a lot of it was highly discretionary expenditure. We felt that it was promoting. So we do draw a distinction between a loan for a home or for a car, for white goods, and loans for fast fashion and more discretionary items. The other concern, and this has still been played out in discussions with the RBA, and they're yet, I believe, to make a decision on it, is whether it's reasonable for Afterpay in their agreements with merchants to say you cannot charge a surcharge to an Afterpay customer. And we think that goes against those hard-won gains which were achieved in the credit card sector, where credit card companies were made to stop prohibiting surcharges. We believe merchants should be able to pass on the cost of credit to the person who is accessing that credit. They're currently not able to. We've had engaged with Afterpay on the issue, and they're still pushing the line that they want to restrict merchants in that way. But we think credit should be a user pays sort of proposition. So at the moment, we've got someone who can't access Afterpay, for example, paying more to buy goods through a merchant which is offering Afterpay than they would otherwise, because essentially that cost of Afterpay is being spread across the pricing of the merchant.
Thanks so much, Stuart. There was another question in respect to the Marsh example and the divestment. And the question is around how impactful do you think that divestment was actually for Marsh, in terms of what sort of position did we hold, what sort of dollars in terms of the divestment, and how does that really impact?
Yeah. So listen, it was about $5 million. So in the scheme of things, the market cap of Marsh Group is not big. They're not. We found people to buy the shares pretty readily. But divestment has an impact on the capital front at scale. So if it's not just us, it's others, then obviously that has an impact on the cost of capital of a company, particularly at the current time when lots of companies are looking to raise some capital. But it's the public component of us divesting, which also we see has significant impact. So I guess the first thing to say is I think we had an influence through our engagement before we divested, because I think Marsh came out with a policy that I mentioned to say, listen, there's circumstances that we won't support certain projects. It didn't meet our standards. It didn't go hard enough. We were very clear about what we were looking for, and they just didn't get across the line on that. So that was why we divested. But we think, we're then talking in the Australian Financial Review, a headline is Marsh loses ethical status. We're talking in sort of international insurance industry press about our reasons. So we think that makes a difference. That has an impact on directors, senior management within those companies in terms of the decisions they make, and whether they would do business for something like an Adani Carmichael mine again in the future.
Perfect, thanks, Stuart. There's another area of interest in terms of the questions coming through today, and that is land-based animal agriculture. You spoke to the fact that we don't invest at the moment. There's a couple of points to this across a number of questions. Does that mean that we see a future based only on plant-based diets? But further to that, would we consider things like regenerative agriculture, a system of farming that builds soil and captures carbon, holistic management practices in that land-based area? There's lots of opportunity for more sustainable agriculture across animal plant-based agriculture. Do we see just a future around sort of plant-based diets? So we're not out there saying, this is what people ought to eat. We do think people should be thinking carefully about the amount of animal protein they consume, both from a health point of view, from an environmental point of view. It's obviously much more emissions intensive, depending on the food, but beef in particular, multiples of greenhouse gas emissions compared to a plant-based protein, and also because of the animal welfare issues associated with conventional agriculture. But with the rising middle class across the world, the point is we can't deal with climate change if we all were to adopt an Australian diet, eat the same amount of animal protein as we currently do. If that's replicated in Asia, a rising middle class, for example, the numbers don't add up. What we're saying is let's think about
our diets, in terms of where we're allocating capital in that sector, we're going to focus absolutely on plant-based protein, and that includes alternative meats in the sense of plant-based burgers and things like that, but also potentially if it achieves some of its initial promise, cell-grown meat, factory-grown meat, you disconnect the protein from the central nervous system, the brain of an animal, then obviously that solves a lot of animal welfare concerns. There's interesting things happening with seaweed as a feed for cattle. So lots of things we'll keep an eye on, but at the moment, applying the charter, animal agriculture is not a place where we're investing.
Thanks, Stuart. So while we're just quickly on the food framework, you did reference that, and I know that you and your team have done a little bit of work on that in the last couple of years. What are the key considerations? What are the key things that you're looking to exclude?
Okay. So just in terms of the principles, what are we saying that before we'll invest in food or food production, it's got to be part of a healthy diet. So at the moment, that would see us rule out, for example, on the plant front, sort of refined sugars. So listen, sugar obviously can be consumed responsibly and in a part of a healthy diet, but that's not the way it's consumed in our society at the moment and in so many foods. So we rule out sugar production under that pillar. The second thing we look at is the environmental footprint of the food. So I've mentioned that in terms that's greenhouse gas emissions, but it's also water footprint and so on. And again, if you're growing plant feed to feed animals, to produce food for humans, it's not surprising that tends to be a much higher footprint source of nutrition than plants. So that's where that's a big challenge for any sort of animal agriculture investment for us. And the third element is, well, how is the business operating? How is it treating its employees? And how is it treating the animals if it's an animal agriculture play? So employees, been lots of, we like to think that human rights concerns, worker mistreatment is something that's more associated with emerging developing economies, not Australia. We've seen that that's not the case when we've looked at supply chains, agricultural supply chains in this country. So that's also something we look at carefully.
Perfect, thank you. On the issue of climate, since we've spent a little bit of time there, and climate change, we spoke earlier about the bushfires and potential of a post-COVID green recovery and demand for that. What is your perspective on the responsibility of investment managers and super funds to more rigorously address this?
For 30 years we've thought it's a core responsibility of investment managers. And that doesn't need to be exactly the way we do it. We think ethical screening, it's what we do, and it's what people come to us for in very many cases, because they just don't want their capital allocated towards a new coal mine, for example. But it can be through engagement and advocacy, and I think we've seen some improvements on this front. But we do think that investors have an obligation and responsibility to use their public voice to call for example, stronger, more coherent climate policy from Commonwealth and state governments. We need, our view is a broad-based carbon price is the most effective way of getting markets to address a challenge like climate change. And that's in Australia, that's globally, and that is part of the broader climate objectives underlying the Paris Agreement. And so we do think it's such a lost opportunity that debate has been mired in politicisation. So we think, listen, boring long-term investors should be a part of that conversation. Fossil fuel companies are out there doing their thing. Civil society, NGOs, activists are doing their thing. Let's bring the boring long-term investor to the table and try and have a more constructive conversation about good climate policy.
Thanks, Stuart. I think they're the key ethical questions. There's a couple of other questions we've received through the chat around some of the funds and fees and things like that. And we will ensure that we respond to everyone directly post the webinar. But with no final questions, I think we're done for today.
Okay, fantastic. Thanks everyone for your time on behalf of Leah, David and myself.